Ginkgo Bioworks Holdings Incorporated saw its shares hit a new 52-week low on Tuesday, trading as low as 49 cents before settling at 50 cents. A total of 13,091,334 shares changed hands during the session, compared to the previous closing price of 51 cents. Wall Street analysts forecast growth. Ginkgo Bioworks has been the focus of several research reports recently. Here's a summary of their ratings and target prices. Biotech Research downgraded Ginkgo Bioworks from a neutral to a sell rating on May 15th. TD Cowen lowered their target price from $7 to $3, but maintained an outperform rating in a report on March 1st. Morgan Stanley reduced their target price from $2 to $1 and set an equal weight rating on May 15th. William Blair downgraded the stock from market perform to underperform on May 10th. In summary, 3 analysts have rated the stock as a sell, 2 as a hold, and 1 as a buy. The consensus rating, according to MarketBeat.com, is hold, with an average target price of $1.90. Analysis. Despite hitting a new low, Ginkgo Bioworks remains a topic of interest among analysts, indicating varied opinions on its future performance. Some analysts are quite bearish, citing a potential downturn, while others still see an opportunity for growth, albeit with a much lower target price than previously anticipated. Investors should keep an eye on the stock's performance and the broader market conditions, as these ratings and target prices may influence trading decisions in the near term. Ginkgo Bioworks saw a slight uptick, trading up 1.1%. The company has a market capitalization of $1.14 billion, a PE ratio of -1.17, and a beta of 1.24. The stock's 50-day moving average is 83 cents, while its 200-day moving average stands at $1.17. In its latest quarterly earnings report on May 9th, Ginkgo Bioworks reported an earnings per share of 8 cents, matching analysts' expectations. The company generated $37.94 million in revenue for the quarter, falling short of the anticipated $45.50 million. With a negative return on equity of 56.09% and a net margin of -409.11%, the financial results mirrored those of the same quarter the previous year. Analysts project that Ginkgo Bioworks will post an EPS of -0.3 for the current fiscal year. Ginkgo Bioworks has seen notable insider trading activities recently. Director Marion E. Deckers sold 265,000 shares on May 16th at an average price of 83 cents, totaling $219,950. Post-sale, Deckers retains 5,515,364 shares valued at around $4,577,752.12. This transaction was documented in a filing with the SEC. In contrast, Director Harry Sloan acquired 297,619 shares on May 14th at an average price of 91 cents per share, amounting to $270,833.29. Sloan now holds 718,540 shares valued at approximately $653,871.40. This purchase was also disclosed in an SEC filing. Overall, insiders sold 377,415 shares, worth $321,226 in the last quarter. Corporate insiders currently own 15.05% of Ginkgo Bioworks stock. Despite some positive movement in trading, Ginkgo Bioworks faces significant challenges. Its financials show persistent losses and a negative return on equity, indicating that the company has yet to find a path to profitability. Insider trading activities suggest a mixed sentiment among top executives and directors, with some selling substantial amounts of stock while others are buying. For investors, the company's current performance and future projections provide a complex picture. While there is potential for growth, as indicated by some bullish insider purchases, the financial metrics suggest caution. Keeping an eye on upcoming earnings reports and insider activities will be crucial for those considering an investment in Ginkgo Bioworks. A number of institutional investors and hedge funds have recently been active in trading Ginkgo Bioworks stock. For instance, Spire Wealth Management acquired a new stake in the fourth quarter valued at around $25,000. Similarly, Prime Capital Investment Advisors LLC also established a new position in the fourth quarter worth approximately $37,000. In the first quarter, Paloma Partners Management Co. took a new position valued at about $28,000. Smith Sally and Associates doubled its holdings in the fourth quarter, now owning 24,000 shares valued at $41,000 after purchasing an additional 12,000 shares. Lastly, Headlands Technologies LLC bought a new stake in the third quarter, valued at around $53,000. Overall, hedge funds and institutional investors currently own 78.63% of Ginkgo Bioworks stock. Ginkgo Bioworks Holdings, Inc., along with its subsidiaries, operates a platform for cell programming in the United States. This platform is designed to program cells for the biological production of various products, including novel therapeutics, food ingredients, and chemicals traditionally derived from petroleum. The company serves a diverse range of industries such as pharmaceuticals and biotech, agriculture, industrial and environmental sectors, food and nutrition, consumer technology, and government and defense. Ginkgo Bioworks saw its stock drop by about 11% in pre-market trading on Friday after the company lowered its full-year revenue forecast. This adjustment comes amidst business challenges and the impact of a newly announced restructuring program. In response, William Blair downgraded the stock. The guidance cut was revealed alongside Ginkgo's Q1 2024 results, which did not meet Wall Street expectations. The company's revenue fell by about 53% year-over-year to $38 million, and its adjusted EBITDA loss remained steady at $100.1 million. Based in Boston, Massachusetts, Ginkgo attributed the revenue decline to a significant underperformance in its biosecurity segment, where sales dropped around 71% year-over-year to $10.1 million. CEO and co-founder Jason Kelly expressed his disappointment, stating, "We've demonstrated that we can serve a large number of diverse programs on a common platform, but I'm disappointed in our revenues in Q1." The company revised its full-year revenue outlook to $170 million, $190 million, down from the previous $215 million, $235 million, and below the $223.3 million consensus estimated by Bloomberg. Ginkgo explained that the updated forecast reflects a weaker-than-expected revenue ramp, uncertainty around the timing of technical milestones, and the short-term impact of restructuring efforts. These restructuring activities, which include a 25% reduction in labor expenses and layoffs in its general and administrative and research and development functions, aim to make the company EBITDA break, even by the end of 2026 on an annualized run rate basis. Following these announcements, William Blair downgraded DNA to underperform from market perform. Analyst Matt LaRue noted the complexity of the update, saying, "While we applaud the new emphasis on cost control, particularly in the current challenging macro environment, we do not have full confidence in the company's ability to successfully hit all of the targets as outlined given Ginkgo's execution track record." Additionally, Seeking Alpha analyst Richard Durant, who rates Ginkgo as a hold, commented that the company appears to be morphing into a CRO and should be valued as such. The bull case. Adria Tamino presents the optimistic view, highlighting Ginkgo Bioworks' growing number of programs and customers. Ginkgo Bioworks has built a cell engineering platform that has attracted a wide range of customers across industries, with significant growth in the healthcare and food and agriculture sectors. In the pharmaceutical and biotech industries, Ginkgo's number of active programs increased by 20% in the first quarter, compared to the same period last year. In the food and agriculture sector, the number climbed more than 50%. Ginkgo Bioworks is working with some of the biggest names in these industries, including Pfizer and Syngenta. For example, Pfizer is using Ginkgo's platform for the discovery of mRNA molecules across its key research areas. This deal offers Ginkgo upfront payments, milestone payments, and potential royalties on product sales, potentially resulting in long-term revenue. These partnerships are crucial for Ginkgo, as they provide not only financial support, but also validation of Ginkgo's technology and capabilities from industry leaders. Total active customers increased by 37% in the first quarter, and Ginkgo predicts at least 100 new projects this year. This growth in customer base is a positive indicator of Ginkgo's market relevance and the increasing demand for its services. Despite challenges, such as a decline in revenue from its peak and an unstable biosecurity business, Ginkgo is taking steps to address these issues. The company recently announced a plan to reach adjusted EBITDA break even by the end of 2026, which includes reducing annualized run rate expenses by $200 million by mid-2025 through consolidating foundry operations and cutting its workforce. The bear case. Keith Spates presents the bear case for Ginkgo Bioworks, noting that more than 22% of the stock float was sold short as of May 15, 2024. This indicates that some investors are betting that Ginkgo shares will decline further. The company's revenue sank by 53% year-over-year in the first quarter, and it posted a net loss despite having a hefty cash stockpile, Ginkgo's current rate of losses suggests that this won't last long. One of the major concerns for investors is Ginkgo's inability to maintain a steady revenue stream. While the company has shown impressive growth in the number of programs and customers, this has not yet translated into consistent financial performance. The volatility in revenue is a significant red flag for potential investors, as it raises questions about the sustainability of Ginkgo's business model. Recent performance and layoffs. Unfortunately for shareholders, Ginkgo Bioworks' share price has dived 47% in the last 30 days, prolonging the pain of a 77% decline over the past year. Despite the heavy fall in price, Ginkgo's price-to-sales (PS) ratio remains high at 4.5x compared to the industry average of 1.5x. This high PS ratio suggests that investors still expect strong future growth from the company. However, the high PS ratio can also be a double-edged sword. It indicates that investors have high expectations for Ginkgo's future performance, and any failure to meet these expectations could result in further declines in the stock price. The market's optimism is based on the assumption that Ginkgo will deliver exceptional growth, but this is far from guaranteed given the company's recent performance. Ginkgo Bioworks has begun making layoffs, which were signaled during a quarterly earnings call earlier this year. The company, headquartered in Boston's Seaport, had 1,218 employees at the start of the year. A spokesperson confirmed that layoffs are ongoing, and no additional layoffs are planned at this time. These layoffs are part of Ginkgo's broader cost-cutting strategy aimed at improving financial performance and achieving break-even. Conclusion: so should you buy Ginkgo Bioworks stock or avoid it? Different investors will have different answers. Ginkgo certainly faces risks, but the company's turnaround strategy could pay off and reward patient investors over time. The bull case focuses on the potential rewards, while the bear case highlights the stock's risks. As always, investing involves taking on risk for the possibility of gaining rewards. It's up to individual investors to decide whether Ginkgo Bioworks is worth the gamble.